There's some more here, some good examples where we have an overbought stochastic, and this is something I call a one up, one down, and there were some questions on it. In this case, it's a one down, one up. A one up, one down often occurs at the bottom, and I'll see if I can find an example. But here we have a one down, one up type of pattern, and what I'm going to do is clarify this for you in a minute. Now, this is not as clear as some of the other candle patterns. This is called a hanging man, and it occurs at the top of a trend, and it's often a reversal signal that the trend is about to reverse. The same thing happens on the bottom of a trend. Instead of a hanging man, it's called a hammer, and I'll see if I can find an example of a hammer in a minute. The problem with a hanging man, the hanging man is really the opposite. There's a spike high, which is a reversal signal at the top of a trend, and here we have a spike low at the top of a trend, which you'd normally want to look for at the bottom. But it's also known as a reversal candle because it's called a hanging man, and it's often a signal of reversal as well. But if you do get a hanging man, what I like to do is to wait for the next candle, because this one is not such a high probability candle. I like to wait for the next candle to form a spike high, and you can see that's exactly what happened here. So the hanging man was confirmed by the spike high. The spike high often forms a higher level than the hanging man, obviously, because we've got to go up and then come down. But what we've now got is a one down, one up. That's the one that's down, this is the one that's up, and that two candle combination is a very powerful reversal signal. It incorporates the spike high, of course, which we've been talking about, but it also incorporates the spike low or hanging man candle, and it forms a powerful two candle pattern reversal. Now at the bottom of a trend you get a one up, one down, and I'm going to show you that in a minute, but that's what we have here. Now you can see that one worked out pretty well. Stochastic was overbought, we were through the Bollinger Band by quite a margin, and then we began to move down, and that took us to this very nice move down once again about 24 hours later. So once you get into a trade, don't assume that you should be getting out an hour or two later. This is not a scalping system or a short-term day trading system. This is looking for the bigger moves, and you can see, had we been patient here, we would have got a great opportunity to pick up quite a nice move from 49.20 or so down to 47.80, at least 100 pip profit. What I'm going to do now is to look for a one up, one down at the bottom, and what that would be called is a hammer candle followed by a spike low. And you can see there's another reversal. These are all spike lows. Then we have, here's a good example of the other candle pattern that I want to highlight to, and I'm going to try and put some labels on this video so that you know exactly what I'm talking about. But what this two candle pattern here is what's called a piercing pattern. Forget the stochastic for the moment. I just want to highlight the candle pattern. It's a two candle pattern where the first one is a bearish candle, which we have here. That's a very bearish candle, and in fact there's hardly any wick. It's just a long black candle down. The second one should go just a little lower. This one's only gone a fraction lower, but still it's a good example. Just a fraction lower, and then it should be a bullish candle where the body of the candle, the white part, in other words the bullish part of the candle, extends more than halfway up the body of the black candle. Let me just repeat it. It's a two candle pattern where you have a bearish candle, the more bearish the better, and then you have a bullish candle which goes slightly lower than the bearish candle, can go a lot lower in fact, but then closes in a bullish fashion. We have a white candle with not too much wick, but it closes more than halfway up the original bearish candle, and that's called a piercing pattern. Now the same thing can happen at the top of a trend, and what you get then is a bullish candle followed by a bearish candle which closes more than halfway down the original bullish candle, and that's called a dark cloud cover. But we don't have an example of that just yet, so we'll get back to that. What's interesting here is we had the reversals taking place over here, and we went along for a number of hours, and then we had a reversal confirmation. So reversals taking place here with the spike lows, lots of spike lows taking place, oversold stochastic, and then we moved along again for about 12 or 15 hours, and then we got this confirmation with the piercing pattern. So a very nice reversal pattern altogether there, stretching out over a number of hours, but two clear areas, which was confirmed by the second one. And then you can see we had a very decent move up from 46.60 to 48, another 140 pip move. So what I'm looking for is a one up, one down at the bottom of a trend. We talked about the one down, one up. So let's look for a one up, one down. And these aren't normally very difficult to find, these patterns. If we just scroll through, we normally find them. There's another spike high followed by a bearish candle. Sometimes people might like to wait for a confirmation of the spike high by a move down below the low of that spike high before entering the trade. That's not a bad technique. There's a very clear doji. You can see through the Bollinger Band, spike low, and not quite oversold there, but nicely through the Bollinger Band. Alright, now let's see if we can find a one up, one down at the bottom of a trend. I'm just going to pause this for a minute and see if I can find one for you. Right, I've switched to the pound chart now, and I'm still looking for one up, one down, but while I was doing that, I came across this beautiful reversal pattern here. Now look at these two Bollinger Bands, the 100-hour Bollinger Band, the grey one, the 200-hour Bollinger Band, the green one, touching perfectly at this reversal point. Now I wonder if you can spot what that is. We talked about it a few minutes ago. Well, if you can't remember, it's called the piercing pattern. In other words, we've got this big bearish candle piercing through the Bollinger Bands, piercing the low, and then we have this bullish candle with very small wicks extending, well, just above halfway up through this bearish candle. This has formed the two candle pattern called the piercing pattern. Stochastic pretty much oversold. The two Bollinger Bands touching, always a fantastic opportunity, high probability trade, and that gives us the piercing pattern reversal and a magnificent move up thereafter, all the way up to the top Bollinger Band, which is really what we're looking for.